Good morning, everyone. Welcome to the Precious Metals panel. I'm very pleased to introduce the speakers on the panel today. First up, we have Adrian Day, Portfolio Manager at EuroPac Gold Fund. Secondly, we have Maria Smirnova, Senior Portfolio Manager and Chief Information Officer at Sprott Asset Management. And lastly, we have Ellie Owens, Financial Manager at Auramet. So we just heard from Adrian in terms of the gold in review and where gold has been. Just to recap, for those of you who haven't been following, the NASDAQ this year is up 21%. The S&P 500 is up 23%. GLD, so that's the gold price, is up 31% as of this morning. GDX, the Gold Miners Index, is up 39%. And GDXJ, the Junior Gold Miners Index, is up 43%. So gold has actually been a good place to be year to date, despite all the underweight that Adrian was talking about. So maybe I'll throw it up to the panel in terms of what do you think's been driving this gold price move? So whoever wants to go first.
Well, I think we heard a lot about that from Adrian just recently, but sort of to reiterate, as Adrian was noting, really it's not what you typically see driving the gold price. You're seeing a lot of central bank buying. It's varying reasons for different central banks. Since the Russian invasion of Ukraine, you saw a lot of emerging markets trying to de-dollarize, and therefore they were buying gold for that reason. In the case of Russia, sometimes it was more to get access to the US dollar. So it's quite variable in those reasons, but that's a big aspect of it. And then the follow-on effect from central bank buying was a psychological effect, especially we saw that this year. Early on in the year, lots of funds weren't holding as much gold as you would normally expect them to hold in anticipation of rate cuts later this year, which would then, in their mind, have an increase in the gold price later this year. But that didn't happen with central banks buying, so you saw a lot of funds, getting their act together after Q1 and buying in those dips. So I think those were two big reasons, but there's many more. And pass it off to.
I don't want to repeat everything both of you have said, but I would summarize. I think, Adrian, you said it the best, is gold to me is the anti-fiat currency. It's a currency. When people call gold and silver commodities, that kind of rubs me the wrong way because I view them as currencies. These are the oldest currencies in the world. Let's remember that. And they're not going anywhere. They're indestructible pretty much. And even though the criticism for gold and silver, I always bring in silver, by the way, you hear me do that. The criticisms can be, there's so much gold on surface, right? Why do we need more? Well, we do need more, and for all the reasons the both of you have said. Countries outside of the Western world are busy stockpiling gold to have that financial protection for their people, for their countries, for the future. And I think they have much more longer term outlooks than we do have in the West. And I think that's the main difference. When I look at how China thinks about things versus how the US or Canada, I live in Canada, how our governments think about things, and my mind is boggled about the differences in mentality.
Yeah, I'll go one step further than you, Maria. I don't think gold is a currency. Gold is money. The dollar is not money. The dollar is a piece of paper with ink on it. And as von Mises said, only a government could put two valuable commodities together and make it worthless. So gold is money, you're absolutely right. And Ellie, if I may, just to add to something you said, obviously we know that the weaponization of the dollar, which has been going on for years, increasingly, right? You remember the huge fines that the US government imposed on Banco Santander for having the temerity to lend money to a Spanish company building a hotel in Cuba, which is perfectly illegal in Spain, in Cuba, under United Nations law and everything else, but they made the mistake of using the SWIFT system. You remember that a few years ago. So this sort of weaponization of the dollar has been going on for years, but clearly after the invasion of Ukraine and the confiscation of Russian assets, it's sort of stepped up. But I also think if you stand back and take a broader view, there's another reason the central banks have been buying gold, and that is simply to diversify their foreign reserves. You go back to the 1990s, and the dollar represented as much as 80% of global central bank foreign reserves. That's reserves other than their own currency. That's declined steadily over the last three decades, and it's now, what, about 55%? And so, I mean, I think there's just a natural diversification of assets that we're seeing. And if you're a central bank, you know, what can you buy? You can buy a little bit of euro if you really want to. But I mean, very few central banks own anything other than the US dollar and the euro. You know, other currencies are just too small for them. And so gold is really, you know, the obvious choice.
Thank you. So just to broaden the discussion a little bit, this is a precious metals panel, so that doesn't just include gold. Maybe just to bring in silver. For those of you who haven't been following, silver is actually up 45% year to date, so outperforming gold. And so I'd like some discussion on that in terms of, you know, what do you think is driving silver? Historically, there's been this gold-silver ratio. More recently, silver's role in the critical metals, you know, in the critical metals area has become more prevalent, and it might continue. So I'd like for all of you to share some thoughts on that.
This is where I go, me. Can I go first?
Yeah.
Okay. I love silver. I've been following silver since 2012, which is not that long, but you know, I haven't been in this business that long. So yes, you hit on it. It's both. I call it a metal of two heads. It has the investment head and it has the industrial head. So it's two halves. And both are obviously in a time. I'm psyched about silver. What's happened last week and continuing into this week is very exciting, breaking through 32 an ounce. So why is that happening? Well, on the investment side, as we've talked about gold, similar drivers are applying, right? As interest rates are going lower, that monetary driver is kicking up. Two countries that have been absolutely instrumental in kind of having high demand for silver recently are India and China. India is in there as well, not just China. And partly is for monetary reasons, but the second part is for industrial. And industrial is obviously solar, right? Last year, the solar demand worldwide in silver was over 200 million ounces. The market in silver is 1 billion ounces a year. That's production. The demand is actually 1.2. We are sitting in a structural deficit in silver right now of over 200 million ounces a year. That's 20% of supply. To put it in context, and my job every day is to meet with mining companies. To put it in context, 200 million ounces a year is between 10 and 20 large silver mines. Because a large silver mine is about 10 million ounces. That's a large silver mine. The silver market is tinier compared to gold, and it's harder to find silver deposits. And all of that is played into this deficit, and I think it's going to continue. And that's just going to fuel the silver price even more, right? So we have very sound demand reasons for silver, but we also have a shortage of supply that is not changing anytime fast, and it's not going to change anytime fast.
Great. Anyone else?
I don't really have too much to add to that. I think Maria's got the silver market covered. I mean, I guess when you know, there has been some reduction in demand for silver within solar panel cells because of an improvement in efficiency in their use, but you're going to see more overall buying of solar panels and use of it. So that's probably going to balance out.
That's a good point about the thrifting, but offsetting that, and I can show you data, the new technologies are actually using more silver, and we are seeing a shift to new technology in solar where the new panels will use more. So there's a trade-off.
Yeah, the only thing I'd add, I mean, you both have covered it very well. The only thing I'd add is we all know that there's a difference between gold and silver with regard to the demand side. You know, silver is much more industrial, and those industrial demands have actually increased significantly in the last couple of years. But I think there's two other important differences. One difference is that there are not huge above ground stockpiles of silver the way there are of gold. So when gold shoots up, you always have the potential for some of that gold to come into the market. You know, few, I don't know if any, you would know, but very few central banks own any silver at all, and I don't think that's going to change. So you don't have these stockpiles. And the second thing, on the supply side, there's a huge difference between gold and silver, and a difference, frankly, in how silver is today with how it was 40 years ago. You know, 40 years ago, something like 75% of silver production was from primary silver mines. Right now, the Silver Institute, I think, says 30%. I think it's even less than that. But let's go with 30%. A maximum of 30% of silver is from primary, and the rest is byproduct. And that's very, very important, because the byproduct silver is typically a small amount of either a copper mine or, more often, a zinc mine, a lead mine. And that has very important ramifications for supply, because what it means is that the supply of silver does not change, even in a longer term period, with the price. If you're a lead miner in Bolivia and 10% of your revenue comes from silver, you don't suddenly decide to build an expansion because the price of silver moved up 30%. And so the silver supply does not change much in changes in the price. That's an important point.
Great. Before we get into the outlook and some thoughts on targets, just to round out the precious metals group, PGMs, I guess, doesn't get a lot of commentary. The platinum group metals, including palladium, platinum, and rhodium, both of those, I think palladium's down a few percent this year, platinum's up a few percent. It's been I guess it's the flip side of the clean energy trade. Platinum and palladium used as catalysts in traditional motor vehicles, and as we've seen a move to hybrids and it's to EVs, they've been unloved. But with the prevalence now of hybrids, you've seen a bit of an increase in demand. Just wondering if any of you have any thoughts on that. I guess there's a dual use. It's industrial. It's also precious. Any thoughts on the PGMs, as in platinum, palladium?
One thing I'll say on the PGM side is I think that in general, the move to electric vehicles is not going to be as quick as people would like it to be. And I think that, you know, we've seen the early buyers of it in people that just think it's really cool. And so they're going to go out and buy an electric vehicle. But when you look at general individuals, they're not necessarily going to switch over to electric vehicles as fast as we think they are, because there's a low range. Maybe it really only works if you're commuting within a city. And therefore, I think the early sort of lack of love on PGMs was sort of an anticipatory switch to electric vehicles that will be slowed down a bit in the near term.
Yeah, and I think you're right. We're going to, you know, most of the people who own an electric vehicle also have a proper car in the garage to go on, long journeys. As electric vehicle, as you know, you go down market, if you like, and start getting to, I won't say poorer people, but, less wealthy people who can't afford a Tesla, they're going to prefer a hybrid over an electric because they can't afford two cars. They don't want two cars. And so I think hybrids are probably going to become more popular, as you mentioned. And yeah, I mean, I would think that palladium in particular is is it a good price to buy now? But I don't really think of them as precious metals myself. You know, I think of gold and silver quite distinct from platinum and palladium, to be honest. That's just the way I put it in my portfolio.
Just on that electric vehicle demand too, aside from the price, what people won't do for their lives, they are not going to make it more inconvenient. And so if your building that you have a rental unit in if your landlord's not going to put in a charger in that building, you're just not going to buy a car that's electric because it's more inconvenient for you. And I think that's a big part of it.
Great. So looking forward, this is an investment conference, so I'd like to give the audience some projections and investment ideas. So moving forward from here, gold is now $27.30. It's up about 30% from here. What is your outlook for gold, for potentially the gold miners or the junior miners as well? More recently, we've seen treasury yields rise in the US, which traditionally hasn't been good for gold. We've got a US election in 2 weeks from now. Some would say if Trump came in, tariff policies would be inflationary. Others would say if Harris came in, more spending and increased deficits. So I'd just like for each one of you to think about how you think about the world, where gold goes, and what's the best way to play it. Is it gold miners, junior miners, something else?
What? Go ahead. Oh, okay, I'll start with this one. The way I look at gold specifically is longer term as well. And I know last time Trump won, gold rallied, then crashed, and it was a big kerfuffle. But for me, it doesn't really matter who wins in the election, and I try not to even think about that. For me, again, to go back to the original idea of gold being money, and countries around the world outside of the US and Western world stockpiling this stuff. Their longer term thinkers are not price sensitive in the longer term. They might be price sensitive in the shorter term, and they don't want to maybe chase the gold price, but in the longer run, it doesn't matter. Unless we have an influx of gold out of the blue sky that kills the market, and unless we have US, Canada, Europe, all these countries fixing their fundamental fiscal, I call it fiscal fantasy land, unless they fix that I stole from The Economist, by the way, fiscal fantasy land. Unless we do that, and I don't see any politicians doing that, not in Canada, not in Europe, not in the US, gold's not going anywhere. And that's my view. And I also say nothing goes up in a straight line. And by the way, we need a consolidation. I'd love a consolidation. I don't love seeing this. I like seeing step and step change, right? And that, to talk about stocks, we malaise about why mining stocks don't get any love is because people don't like volatility. Some of the best performing gold stocks this year have been companies that are just delivering steady Eddie results. They don't have any mess ups. They're just delivering results quietly. And that is what we need in the gold and silver market. We just need that continuation of kind of confidence building continuation of results. So for us, when we invest, we're seeing the greatest opportunities in the smaller to mid caps. That's how Sprott has been traditionally. I look at liquidity. So unfortunately, I need more liquidity in the market. But that to me is the small to mid caps right now are great opportunities. I know, Adrian, you talked about Agnico's valuation, but we see these silly valuations in a lot of names. There's a lot of upside still.
I guess I'll touch on the geopolitical front a bit. Right now, we're seeing a pretty strong premium on the geopolitical risk hedging in gold. And you can see that when you look at the gold price versus any defense stock like Lockheed Martin or something. So obviously, we've been in a pretty high geopolitical tensioned environment, especially for the past 2 years, and then especially again for the past year. And over the past couple of weeks, we've been on a roller coaster of, wait, maybe it's going to slow down a little bit. No, never mind. Maybe it's not. I think we thought when Yahya Sinwar was killed, then perhaps Israel would be ready to settle. And now it's not looking that way. So really, when we see these we have a pretty big premium on geopolitical risk. Tensions don't seem to be going down too much. But the one factor that I think is maybe different than 30 years ago is the coverage of these geopolitical events. And I think that's playing a really big role in how these geopolitical events are getting translated to an increase in the gold price, because everybody has a phone. They can all film, and we see in live time what's happening in Gaza, what's happening in Ukraine. So we're getting a translation of this information a lot quicker, and therefore people are reacting on it a lot quicker. And I'll give you an example. When Iran sent 180 missiles over to Israel, the end result was kind of, and nothing happened, but it still actually had an impact because we were seeing it as the missiles were coming over. But 30, maybe 50 years ago, had the same event happened, the headline the next day, I mean, it would have been 180 missiles were sent over and one person died. And I'm not sure that would have been the headline. So I think we have potentially a bigger play here in geopolitical tensions than we ever used to because of this flow of information. And that's just going to continue.
Yeah, I'll add a few things, if I may. I mean, clearly the geopolitical tensions are, let's say, a positive for gold. I hate to talk in that way. They're clearly supporting the gold price as opposed to being a negative, no question. And you're absolutely right that we get instantaneous news, so we get the firing of the missiles before the missiles are all shut down. But typically geopolitical events really they tend to have really short-lived spurts in the price of gold, and this is true all the way back, to the Iran hostage situation. It's true of even major events like 9/11 and the invasion of Iraq. You look at the invasion of Ukraine, that was a perfect example where gold moved up significantly in the 6 weeks ahead of the invasion on rumors. I mean, we knew that the Russians were massing troops on the border, and gold moved up ahead of it. Within 6 weeks after the invasion, gold was back to where it had been before that move up. So geopolitical events, in my view, are not a reason to buy and own gold sort of on a long-term basis, but they do give support, obviously, and they do tend to have these short-lived spurts. I mean, I think the main reason, as we've all talked about, the reasons people are buying gold, I don't think are going to go away. We can paint a picture of nirvana. I won't repeat what you said about fiscal rectitude on the part of most governments around the world. It's just not going to happen. There's no prospect of that happening in the foreseeable future. Unfortunately, the U.S. Is likely to continue its policy, if not even increase its policy of trying to use the dollar as a tool. I don't think the U.S. knows that carrots work just as well as the stick. That's speaking as an Englishman, I'm sorry, if that offends anyone. So I think that's going to continue. The reasons that people in the US want to buy gold with lower rates, that's going to continue. So for the foreseeable, I mean, yes, we're overdue a correction. No question. But gold has been remarkably resilient in the last 12 months. I mean, remarkably resilient. So whether there's a correction in the near term or not, I don't know. I don't think it'll be deep. It'll give people who think they've missed it an opportunity to jump in. So over the next year, I mean, I think gold's got to be meaningfully higher from where it is now, and silver.
No one's mentioned China. In the last few years, as the property market and the stock market in China have fallen for retail punters in China, the only place to be has been gold. Now with the stimulus in the last few weeks, with the maybe reacceleration of those markets, is that a risk for gold, or is that... Do any of you think about China?
I think it's definitely a risk at the margin. And, we know the prices are made at the margin. All moves are made by marginal buyers and sellers. Yeah, it's definitely a risk at the margin because the Chinese stock market has been, China and Hong Kong stock market have been just phenomenal in the last 6 weeks since the stimulus. So I think some people will suddenly feel safer going back into the stock market, but they still don't want to put their money in the bank, and they still can't buy crypto, and they still don't want to buy real estate. So I think gold still has demand from China.
And I would add to that, though, my understanding that in China, the trend has been for younger people to start investing in physical gold. You know, you see pictures of them selling little gram nuggets. You know, this is to make gold more accessible, right? And of course, a lot of the inflows have been into gold ETFs in China. They have their own products, and that's been taking off like this, unlike here. So that's been interesting to see, that proliferation of products and making it more available to people.
You asked about the gold stock side of things earlier, and Adrian showed us a lot of historical information about gold stocks being very strong performers during recessions and et cetera. One thing, though, that I don't want to be too much of a dampener, and I'd love to hear what you guys think about this, but one thing that is concerning me a little bit is the demographics coming up to play here in the stock market side of things. Typically, people, when they're in their 30s and 40s, they're building their wealth, they're having kids, they're spending a lot of money. So I shouldn't say building their wealth, they're just spending their money on things. You don't really build wealth until you're in your 50s, and that's when you have that's where you get liquidity for stock markets is people in their 50s and up to when they retire, 65 to 75. And we're in the middle of the baby boomers retiring. And when people retire, it's not usually a super gradual shut off of their risky stock exposure. They just shut that tap off. Versus in their buying phases, it's a more gradual ramp up to buying risky stocks. So I am a little concerned that there's not a demographic following soon behind that will then fill in that gap of that shut off there, especially since that next bigger generation coming behind has a bad perception of mining, really, doesn't like mining. I think a lot of it is misinformation. I think they don't understand mining, and understandably, it's hard to go up and visit an exploration site and double check that what we're saying is true. If you do come up to this site, then I'm just going to show you a rock and say, yeah, there's gold in it, but you can't see it. But it's there, trust me. So it's a pretty inaccessible industry that way. But so I think there's a bit of a demographic shift that I'm a little concerned about.
Well, I would say that we've been battling these demographics already for the last number of years. In Canada specifically, again, my knowledge is mostly in Canada, advisors have a hard time with allocating gold stocks to portfolios because of these risk ratings that you mentioned, right? So that's already been in place. That's partly why we've had struggles in the mining equity markets, right? So I agree with you. We need to bring the young generation in, and that has to start early. That has to start in school, likely, right? And educate people. How we do that, that's a very big question, but it is a good point. I actually just had last week an advisor say to me that he's had interest from young people, which I was like celebrating because I thought that was excellent. But yes, it's something we need to work on as an industry.
And I'll just give you an anecdote here on that note. I'm originally from Toronto. I'm based out of Manhattan now, but I'm from Toronto. And whenever I go to parties that are not mining related parties and I say I'm in the mining industry, I always get people saying, oh, we have gold mines in Ontario? Yeah, we have some of the historically most important gold mines in the world. So yes, we do. And it's shocking to me that that people in Toronto, which is the mining financial hub, if they're not in the mining industry, they don't know we have gold mines in Ontario. It's wild.
And then you're standing alone at the party.
Yes.
They all
I'm
left
the pariah. I'm the pariah. Yeah.
Yeah.
But we are seeing new buying, not just your anecdote about some younger people going to brokers, but also we're seeing what's happening at Costco selling the gold bars.
Yep.
I think these are all encouraging signs. Again, at the margin, but they're encouraging signs.
The other thing that will attract the younger demographic is FOMO. I think up until the first half, the Nasdaq was kind of outperforming gold, but in the last few months, gold is significantly outperformed. So no one likes to miss out, whether it be on whatever it is.
The other thing I'll say, you look at the gold miners. Obviously gold is making new highs, but look at the gold miners. We've had 2 quarters so far, back to back, of very strong and increasing cash flow and free cash flow. Whoever would have thought gold miners could have free cash flow? Astonishing. Some even have earnings. Did you know that? This quarter, the quarter that's just passed, should be, by all rights, another quarter of very strong and increasing cash flow. Not only was the gold price up, I don't have the number, but probably around, $160 an ounce on average, higher than the second quarter, but also the oil price, which is the main cost component for running a mine, was down, was weak in the third quarter. So the cash flow should be very strong. Year to date, the gold mining sector has the strongest growth in cash flow of any sector. So I've got to think that when you have 3 quarters back to back of strong and increasing cash flow, and you get gold making ever new highs, somebody somewhere has got to notice that.
Yeah, it's an excellent point, actually, Adrian, because this year is the first year in a while that we're seeing margin expansion.
Yeah.
Because in the last couple of years, we've had inflation, and that was affecting the miners. We're now seeing that stabilize. It's not away, but it's stabilized. And the gold prices, silver price are helping, for sure.
And I don't know if you guys talked about this before I came in, but there seems to be a disconnect between the metals price and particularly the junior miners. When you look at the share performance, any explanation as to why that's occurred? The seniors have performed a lot better, significantly better.
So to me, that happens in every kind of start of a bull market. Money goes to bigger, more liquid names first. And as the market heats up, as mining stocks perform better, then people go down market cap. So that's a completely normal situation. And I also mentioned earlier that I think people value consistency and free cash flow and earnings. The bigger guys are the ones delivering that right now, I would say. But it's changing fast. So we're actually, I'm starting to see smaller companies doing better.
Yeah, it's interesting. If you looked at all of the smaller companies, all of the exploration companies, in aggregate, they're not doing well. But what we have been seeing in the last few months, increasingly, is if a company has particular news, then it does move. And that's encouraging because, 2 years ago, if an exploration company put out good news, the stock typically went down because it kind of, I think, the press release reminded people they owned it, and so they sold it. But now we're seeing good news actually is selective, very, very selective. But we are seeing good news being reflected in higher stock prices in the juniors.
I think also a lot of Adrian's earlier talk touched on this, where the environment, why gold is up to date, is for a different reason than traditionally is the reason. And at the same time, the stock markets writ large were doing well. So why would someone go to the junior miner stocks at this point, up to this point? Which I think your commentary earlier was that is now changing and we're moving into a more traditional, strong gold environment. And so you should see that translate more into stock markets, not to put words in your mouth, but you can, I think that's sort of what you're, thank you. I learned really quick.
But I think you're already seeing it translated. So you would have missed these stats at the beginning, but the GLD, so the gold price is up 31% year to date. The GDX, the gold mining index, is up 39%, so outperforming the gold price. And the junior mine index, the GDXJ, is actually up 43%. That's as of this morning. So actually junior miners in the last maybe 6 weeks or so have outperformed, and year to date as well. Yeah, they're coming from a low base. They absolutely are. And I think if you extended that time frame for a longer period, there's probably still a lot of catch up to do. But things are moving. Year to date, they're outperforming. So
Sure. I'll make a comment on that if I may. Yeah, I mean, a GDXJ is outperforming the GDX, but I mean, to me, to call the GDXJ the juniors when they have Pan American, Harmony, Kinross, Royal Gold used to be in it. I mean, these are hardly what I think of as juniors. But on
Fair point.
average, the market cap of the GDXJ is a lot less than the market cap of the GDX, obviously. So the point is valid.
yeah, maybe it should be renamed the mid cap index, and there should be a more junior one. Maybe just some targets, if anyone, just throw out. I don't know, if you don't have to, but maybe the target for gold price, maybe year end.
Well, you know what they say, you don't give a price and a time.
Or okay, so you can give one or the other.
You know, and I also think, to me, the gold price is a reflection of fiat currencies. So the real question to me is how low is the dollar going to go rather than how high is... I know that's a cop-out and it sounds a bit... But, yeah, I mean, by the end of the year, I mean, I wouldn't be at all surprised if we saw 3,000, and that's hardly an aggressive target. To me, much more interesting is the stocks, because as I said, normally at the beginning of a bull market, after gold bottoms, in the first 3 to 6 months, you normally get this dramatic leverage in the gold stocks, in the big gold stocks. And the big gold stocks are typically, I mentioned in the year 2000, the XAU in the first 3 months was up, what did I say, 74%? I've forgotten now. But something like that. If you look at, you know, from 2009 when gold bottomed, the gold market was up 50% in 3 months before the S&P had even bottomed. So typically you get these really big moves at the beginning of a gold market. So I wouldn't be at all surprised if, I don't know about year end, but let's say the end of January,
Yep.
I wouldn't be surprised if at the end of January, stocks like Barrick are up by 50% from where they are now. And that sounds extreme, but it's really only what's happened historically. So I think the gold stocks, both the big caps, which I think still have a lot of room to move because they're still undervalued, and the mid caps that are clearly even more undervalued. A stock like B2, for example, I think could easily be up 50% by the end of January or February.
You saved us from having to make a target, so thank you.
Yes, thanks. Silver to the moon, though.
Yeah.
Well, thank you everyone for joining. Thank you, Adrian, Maria, Ellie, and any questions, please revert to the moderator, to the rest of the panel.
Thank you, everyone.
Thank you.